Now there's a huge difference between the two, and many people don't understand that, but you will. Hey guys, how's it going, and thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because you know schools aren't. Don't forget to subscribe for more videos, so let's get started. So in this video, guys, we're going over the stock market 101. Is it really worth it to invest into stocks? So you want to invest into the stock market to become a millionaire and finally drive that Lambo. But what does it actually entail to invest into the stock market? Essentially, there are two main different strategies that you can take while investing. So the first question that you might have is it even possible to invest into the stock market? Could a normal person do this? And is it like gambling at all? Or you could only make money for insider trading, so you have to constantly be running from the SEC because they're always chasing you. No, because you can pay them off from the profits that you made. I'm kidding, don't do that. So to answer that question, yes, it is possible that essentially anyone can make money in the stock market. No matter how little you have and no matter how much you have, you could still invest with two main strategies, which we're going to go over right now. And those two strategies could be separated into trading, which is essentially holding onto a stock for a finite amount of time, versus buying or buy and hold type of strategy, similar to Warren Buffett, but that's either holding it for a very long amount of time or forever. Now, trading stocks is putting time and effort into researching a lot about the different companies out there, this actual stock price, different news articles, and any other financials out there. You have to make sure you have to buy low, sell high, and you have to consistently do this to make profits. On the other hand of buy and hold for an infinite amount of time, similar to Warren Buffett, or something similar to that, something that I would do, is dollar cost averaging. Essentially, you are still holding it for the long term, but you were investing into the stock market every single month. No matter what happens with the market, if it's up or if it's down, you're consistently investing. Now, most people do this simply because it's quite simple, and also they do it for retirement. A lot of companies, if you have a job, they have a 401k. That's essentially what that does. If you have a separate IRA, like a Roth IRA, you could set something up like that and contribute every single month. Historically, the market has returned an average of 8 to 10% per year. So which one is better for you? Well, it all really depends on the type of person that you really are. If you love researching companies, putting a lot of time and effort into it, consistently making those trades, then it would be great for you. However, know the statistic that many traders, even mutual funds, ETFs, actually underperform the benchmark of the stock market. Simple benchmark is S&P 500. Everyone looks at that. So like we said before, that average return of 8 to 10% per year, a lot of people actually underperform that. They don't even hit that amount. So at the end of the day, you could put all this time and effort into researching all these companies, the prices, financial statements, news articles, conference calls, all these different things, and still underperform, which is actually kind of backwards. You would assume that the more time and effort you put into something, the better the result. Investing is sometimes the exact opposite. The more input that you have, the worse you do. So that could mean a guy is sitting down watching a John Wick movie because the new one's coming out soon and he's excited to see it. Not sponsored, but yes, I will be seeing Keanu in action. And that guy could be doing better than someone who's actually working at trading stocks. So you essentially have to choose. Of course, always do your own research, but it takes a lot of time, and you have to put that time aside to actually do those things. Pro tip, if you do want to outperform the benchmark or the market, you usually have to invest in smaller companies. Smaller companies provide larger growth. They are more riskier. But if you're investing in larger companies, which the market is mostly consisting of, you're going to have similar returns to the market if you're investing in larger companies. So if you go for the smaller company route, you could have better returns. Since this could be toward beginners, I would suggest going for larger, well-known companies, so you actually know what you're looking at first, know the ups, the downs, and the spins of the stock market before actually putting some serious money into more, considering speculative investments. A few ending tips about the stock market is that it is very, 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 very difficult to time the market. There are managers out there, traders that are like considered professionals, and even they struggle to time the market. Get in at the bottom and getting in out at the top. One reason for that is because we're all human beings, and human beings are very emotional. Our emotions usually get us in trouble, like calling your ex when you shouldn't call your ex. Don't call your ex. You might have heard, you might have not, but the idea of passive investing versus active investing, buying and holding, is passive. Even Warren Buffett is telling people to buy index funds, which outperform hedge funds, which are managed by hedge fund managers that like put a lot of time and effort, a lot of, all these expert strategies, and still underperform. Buffett bet $1 million that a simple index fund will outperform these millionaire investments. And he's winning. So the choice is either doing work to outperform, that's the ultimate goal, or sit back, relax, and get market returns easily. And of course, cannot forget the super secret idea of, if you're watching financial videos out there, it's not a secret to you guys, but this is how anyone could essentially get rich and build wealth in the stock market, is the eighth wonder of the world of compound interest. Your money gets money off of your money, which gets money off of your money off of your money. It just builds consistently, exponentially over time. And you could simply become a millionaire with that, even a multi-millionaire. Very simple to comprehend. However, doing that is essentially just consistently doing that your entire life. That's not the easiest part. If you set it up automatically, it could be very simple. But those are essentially the main things to start thinking about the stock market if you are interested in it. So if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. Thank you so much for watching, guys, and I'll see ya in the next one.